What's going on? My name is Matthew Scott. I'm with Baldwin Electronics, and I'm going to be talking you through basically how we won the competition. So, our company value proposition, we strive to provide our customers with the highest quality products at an affordable price. We promised our products will last longer and perform better than the competition. This was something that we put a lot of emphasis on, was our products lasting longer, as we wanted to make sure to keep our mean time between failure down. So we decided to employ a broad differentiation strategy, and we did this by releasing a product in every single segment. In the first few rounds, we invested capital into three things: research and development, promo budget, sales budget, and product automation. We wanted our product automation to be as high as possible to drive our margins. We expected to see a low net profit in the first three rounds, but our early investments helped to obtain higher profits in later rounds. This stood true, as we actually saw a profit way before round three. Research and development focused on raising the mean time between failure of each product to the maximum amount as soon as we could. We planned to launch a second product in the high-end segment, and we wanted our products to be the highest quality for each segment we were in because we thought this would be important, as we thought that the customers would want to buy our products more if they were of higher quality. It seemed pretty simple. Marketing was where we struggled the most. Don't know why. It's just the hardest. But for the low-end segment, we planned on selling at the lowest cost financially feasible, keeping a close watch on our profit and contribution margin. For traditional, we planned on pricing our products just below the competition. And then for high-end performance, we planned to price our products at the highest price customers were willing to pay. We had high spending in our promotional budget in year one, but cut back as time went by. We believed a large promo budget up front, followed by cutbacks, was the best strategy. Now, for production, we kind of had to critique this as time went by, but we wanted to have as much automation as possible to produce our products. We increased capacity and automation for our most demanding products. Like I said, we had to adjust a little bit as time went on to see what our best-selling products were. And then we had high material costs because of our competitive products, but a very low labor cost, as we invested a lot in automation. For finance, in order to finance our broad differentiation strategy, we raised as much capital as possible in our first 3 years of operation. We did this by issuing stock and basically utilizing as much short and long-term loan as we could. Our debt to equity was looking pretty rough for the first few years, but our strategy ensured we had the funds needed to invest in research development, marketing, and production. So it wasn't really a big deal that we were pulling a lot of debt because we had enough money to scale properly. As we approached year 6 through 8, we saw our profits and retained earnings skyrocket. We were able to do a stock buyback, pay dividends, retire long-term debt, and basically drive up our stock price. So let me cut over to the more important stuff. Contribution margin. So as you can see, this is us right here, Baldwin Electronics. So as you can see, in the first couple of years, everybody's contribution margin was fairly competitive, and even through year 3, we were kind of close to the competition, although we started to pull ahead. But around round 4 and 5 was when we really pulled ahead, and we think that was just driven by all of our investing in automation. Now, for our market share, we had a 22% market share, which was pretty good. I mean, we captured almost a quarter of the market, and there were 6 competitors, so we thought that was a pretty good number. Our return on equity was high. Stock price was almost double second place. Profits were extremely high. Return on assets looked great. Let me move on to the more important stuff right here. So we love this chart. This was sales. So as you can see, average sales, 166 million. Second place wasn't even getting over 200 million, and we did over 300 million units. So we were very satisfied with that. We love this timeline here because you can kind of see when we really took off from our competition, and that was around round 3. You can see that all of our early investing in the first couple rounds really didn't pay off, but when we saw the results from round 3 right before we started round 4, we were amazed with what we saw. So the main reason that we think that we really got so far ahead of the competition was really just because of our contribution margin. Most of this was driven by our contribution margin, and if we jump back over here to this chart, we added this because we thought it was very important. But as you can see, our contribution margin was so much higher than everybody else's, so we were able actually to end up profiting much more than everybody else, just because everybody had similar sales. I mean, it's not like everybody had half the amount of sales as us, but everybody was so far behind in profits because we believe that was just driven by all of the investing we did in our plant and R&D to really drive up our contribution margin by having such low labor costs due to our automation. Thank you very much. I hit 5 minutes.